cattle company. He supported us for the last couple of years, and it makes this webinar, makes it possible for us to offer it to you for free. And so if you know Rich or you get a chance to say thank you, please do that. He makes a lot of things possible, and we just really appreciate that from him. So I'll introduce myself. If I haven't met you before in person, my name is Mykel Taylor, and I'm an assistant professor and farm management extension specialist here in the Department of Agricultural Economics at K-State. This is, I believe, the 4th year that I've done this webinar on Kansas agricultural land values. I can say that we haven't had this much interest before, but we're in kind of an unusual time, and I think that's probably why we have this much interest. Is there's a lot of things going on in the land market. We're going to talk about those things, and there'll be time for questions at the end. I've only got about 30 minutes worth of slides just to give folks an opportunity to ask some questions if you have them as we go along. So let's get rolling, assuming I can get my slides to move. There we go. Okay, so some of you have seen this chart before. I put it up there just to give you a sense of where we're at financially in the sector. This is from Kansas Farm Management Association data. So these are real Kansas farms that submit their financial data to a database, and then it allows us to benchmark them against the other farms in the database. And what you can see on this chart is that between 1999 and about 2007, we were barely breaking even on our wheat, corn, beans, and milo enterprises. So it meant when we took into account all of the economic costs of growing those 4 crops, we were either breaking even or losing a few dollars an acre. Then starting in about 2007, 2008, commodity prices started to improve, and so did our profitability. We went on a stretch between 2008 and 2013 that was pretty amazing in terms of our profitability, especially on some of those key crops like soybeans that we can grow in certain parts of the state, double cropping, and so on and so forth. Well, this picture looks great, but you'll notice that it only goes through 2013. And so when I advance the slide, this is what happened to profitability exactly 1 year later, which is we went from well above 50 bucks an acre to well below 50 bucks an acre on our profitability. And then we did it again in 2015. The 2016 numbers from Kansas Farm Management Association will be coming out in mid-May. You're going to want to take a look at those. They'll be on the Ag Manager website, and when those enterprise reports come out and net farm income comes out, what I think you'll see is that we had really good yields in 2016, but really poor prices. And so our ability to recover that profit loss that we've had from a couple of years is probably not going to be there. What does it mean going forward? If we return to average yields with these low prices, 2017, which is the crop we've got in the ground right now, assuming you've been able to get out there and plant, is probably not going to be worth very much. And so it's going to be tough to turn a profit this year unless something dramatic changes. This is a slide, if we take the whole farm, not just the crop-specific enterprises, but the whole farm, and we look at the net farm income per operator, you can see the blue columns give you the return to crop farms. So they have to be at least 70% revenue from their crops. And you can see that we had several good years in a row. This matches those enterprise budgets. 2014, we still made pretty good money because though a lot of folks were selling, had pre-priced their grain and were able to sell at some of the higher prices we saw in 2013. But by the time 2015 rolls around, we go to a net farm income statewide of $4,500, when 2 years prior, we were at a net farm income of about $170,000. That's a huge drop off in a very short period of time. What is happening on the cow-calf producer side? 2014 was a record year. You don't get many years like that in the business. And 2015 obviously was pretty low relative to 2014, but not as bad as what we've seen in some of the earlier years in this chart. Now 2016 is probably going to be lower than 2015 for both crops and cattle. But what you can see here, it's going to show up when we look at the impacts on pasture versus cropland, which is that it's been a little more profitable on the cow herd side, and so it has supported pasture land values better than what has been happening on the crop side. How do we compare to the rest of the country? This is really important to know that what's going on in Kansas is a pretty good indicator of what's going on in the rest of the Great Plains and also in the Midwest. For many years in a row, we were tracking with the same sort of trend as the USDA net farm income. But in 2015, when we fell off so far to $4,500, then you still had a reasonably positive level on that USDA number. The trick there is to understand, though, that that USDA number also includes cotton and peanuts and all your specialty crops, your fruits and vegetables and so on. And they haven't seen the same drop necessarily in commodity prices that we've had on, especially for wheat and then for corn and for milo. So the entire country is certainly seeing a contraction in net farm income, but it's being driven by what's being grown in the Great Plains and in the Midwest. Okay, so let's take a look at land value trends. Before I show you any charts at all, just a reminder that, you know, we've just looked at this profitability in the ag sector and it's fallen off dramatically. Well, we can't talk about that kind of a fall off in profitability and not assume that it's going to affect land values. In fact, I'm going to show you that it has affected land values, and there's a bit of a lag to it. It took a couple years for it to show up in the data, but it does impact it. One of the reasons, though, why we see a lag in that effect is that it takes a while for some of those things to filter through because, well, for example, we don't buy farmland to turn around and sell it next year. If we get the opportunity to buy ground, we plan on holding onto it for 30 years or passing it on to our kids and keeping it for a couple of generations. So we have much more long-term profitability expectations in mind. Now, that doesn't mean that we aren't going to be affected by short-term profitability because we still have to figure out a way to manage the cash flow on that piece of ground. But we do have long-run expectations. And so those things keep that land value from falling off as quickly as the profitability numbers do. And also just the expectations of buyers and sellers. Who's involved in the market right now and what are their expectations of how profitability is going to change over the next couple of years. Those are important considerations that keep the land market moving at a slightly different pace than just looking at net farm income and assuming you'd have a one-to-one relationship. Land value data can be a little bit challenging to find in the state of Kansas. One of the places that we get it is from USDA. The National Agricultural Statistics Service does a survey of producers and lenders, and they try to get some information for us. We used to have a little bit better information, but in 2013 they dropped the CRD level, which there's 9 crop reporting districts in Kansas. So at that point we didn't have it at the county level, but we did at least have estimates for the 9 crop reporting districts. Since 2013, though, we've only had a statewide number, and that number can be a little bit deceiving if you understand that the difference between western Kansas and eastern Kansas in terms of land values is pretty significant. So so just getting a single number for the whole state is a little bit tough to break apart and know what's going on, but it does help us looking over time and across years. So let's take a look at those numbers. This is the cropland values. Remember that they are not distinguishing between irrigated and non-irrigated ground, but we have vastly more non-irrigated ground than we do irrigated. So I pretty much consider this number to reflect dryland land values. That's we're sitting at about $2,050 an acre for a statewide average, and that's down 7.2% from 2015. These numbers came out in August, and so we will see the 2017 land value numbers come out in this August, and so we'll be looking for those to see what they have to say. So their numbers from the surveys come out a little sooner than our numbers that we put out here through this webinar. Here's the pasture land values. They're also down 7.2% with a statewide average of $1,290 an acre. And you can see there's, I'll go back to the cropland, but a lot of places in the Corn Belt and in the Great Plains, the northern Great Plains especially, are down. But you've got some positive or some support on land values for pasture, and again, that comes from not having as much of a tough time going on in the cattle market. There's a little more support on the income side for them. Okay, so let's break it apart now and let's take a look at it over time. What you can see here is the same the same factors that brought in that high profitability eventually translate their way into the land market. So we started seeing profitability jump up in 2008. Well, the land market didn't jump too much, but it slowly started to creep up. And now we've seen this relatively significant run up in land values. On the blue line, which was non-irrigated, went from just below $1,000 an acre in 2017 to a peak of about $2,200 an acre in 2014. And now we're down to 1940. The decline for the last couple of years, from 2014 to 2015, was pretty much flat for irrigated ground. And then in 2016, they have us down 7.2%. We're down almost 10% since the peak for non-irrigated cropland. So the peak being in 2014, according to their land values, we're down 9.8%. And then the peak looks to be 2015 for pasture, and we're down 8.3% from that peak. What's it done to the rent to value ratio? So what this is the fraction where you take the average cash rent and divide it by that average land value, and it gives you a short run return on that land. And at the same time that land values were going up, which is in the denominator, it pushes that fraction down because cash rents just don't change very much. Even in a relatively volatile period, they're still kind of sluggish to adjust. So at the same time that land values were going up, it was pushing rent to value down. What did that mean? Well, it means that, say, 10-15 years ago, you might have gotten between 4 and 5% rate of return on your non-irrigated cropland. Now we're down between 2.5 and 3%. That number will start to come back up if land values fall. So what it'll mean then is that your land is not worth as much, but the return relative to that value will have started to increase again. Okay, so survey data is really helpful because we don't have a lot of other sources of information, but there are some things I think it's worth noting about survey data that can potentially skew it or make it different from market-based valuations. And so it's just worth noting, number one, you're asking for an opinion. You don't have to have bought or sold land in order to fill out the survey, so you're really giving them your best guess. That doesn't mean the answer is wrong. It just means, especially in a volatile market, everybody might be seeing some different things and have different information. It's not a market-based estimate. And one of the things that it would be nice to know is it would be nice to know a little bit about the spread, but they only ever publish the average. So that limits our knowledge about what's going on. And this, of course, is one of those points, if you've ever heard me speak, I give a lot of guff to the producers, trying to remind them that Kansas has a pretty low response rate. We need to bring it up so that we have good data. If you want good data, you have to be willing to provide surveys back to USDA. So that's my little lecture to you guys. So can we add to the available information and improve our estimates? Yes, I think we can. It's not straightforward to have market-based land values in Kansas. One of the reasons is we're a non-disclosure state. And what that means is that you and I can't just go to the county courthouse and ask for a dump of all the land sales in the last 5 years and they're just going to give it to you. You have to be a licensed appraiser or licensed real estate agent, or hold some kind of certification in order to get that kind of data. So the Property Valuation Department in Topeka is a central clearinghouse for all the agricultural land sales that happen in the state of Kansas. And they are a partner with us here in the Department of Ag Econ to provide a county level estimate of land values on an annual basis. So I'm not handing out individual sales data, but I am using that individual sales data to get us to some numbers that we can at least discuss. And it gives us a little more to talk about than just those state level land values from the surveys. So what all is in here? The estimates I'm going to give you today are based on sales from 2014 to 2016. We know what county the piece of ground was in, and so we put some things in there like population density, because we want to account for the fact that we've got some counties that are very populated. Sedgwick County, Wichita, some of our northeast Kansas counties like Leavenworth and Johnson County, and those places, well, that's KC Metro, and so we want to be able to account for the population density relative to some of our less populated counties. We also know the number of acres in the sale. That allows me to account for the impact of having a small parcel versus having a really large parcel. If you've ever seen an advertisement for an auction, they oftentimes will take a chunk of ground and they'll break it into tracts. And so they might have, say, 3 tracts that they're going to sell. And you as a bidder can bid on all 3 and you can buy all 3. But they're going to sell them to you in 3 different pieces. And one of the reasons is the smaller the parcel, the more people that can bid on it. So it does matter how big the parcel is in terms of how many potential buyers you might have. So we want to account for that. We want to account for the type of land. So a lot of parcels that sell in the state of Kansas are some kind of a mixture of cropland and pasture, or if you've got a center pivot on that piece of ground, then your corners are going to be non-irrigated. And so we want to account for what you've got, because there's different productivity, different uses for these different types of ground. So we account for all of that. Then we've got a couple of variables that in running some of these models, I've kind of come to the conclusion that these are 2 of the best variables for accounting for the impacts, especially on dry land and pasture. I mean, if you're able to irrigate, that's, you have some other considerations, but if you're working with dry land or you're working with pasture, rainfall matters greatly. So we use a 20-year average rainfall to kind of capture what the weather patterns are like in that area. And this is at the section level, so it's pretty detailed data. And then the other information that we have is water holding capacity. So this is like an index on the soils that are in that parcel, and it tells us how good is that ground at holding onto water. Not too much, not too clay, not too sandy, but has a good mixture of sand, silt, and clay that allows it to hold water and be a good productive piece of ground. We also know whether or not there's an existing CRP contract on that parcel. That tends to, for those acres, it tends to, they sell at a discount because whatever years remaining on that contract, that's time you can't use it for what you might want to. You can't farm it, you can't graze it. So when there's a CRP contract on all or a portion of a parcel, it does tend to sell at a bit of a discount. We take out the value of improvements. So if there happens to be a house or a machine shed or any kind of buildings that have value, those dollars are subtracted from the total sales price, so that what we're putting into this model is just the bare land value. Parcels under 40 acres are omitted. What that basically means is, the reason I have these data is because Topeka said that this was ag land when it sold. Doesn't mean it's going to be ag land with the new buyer, but it was ag land when it sold. Get kind of nervous with anything under 40 acres because that is developable ground, and that might have sold at a premium just simply because you could put houses on it or light industrial or something. So we keep it to at least a 40-acre size parcel. And when all that's over said and done with, we end up with a couple of counties that don't make the cut. Johnson and Wyandotte actually fall out of the data because of some of those criteria. So let's take a look at some summary statistics on the PVD data for 2016. The average parcel size is about 156 acres. If you're out in western Kansas, those parcel sizes can get up around 250, 300, 350. If you're in eastern Kansas, those parcel sizes are going to be below 100 on average. 4.5% of the parcels sold in 2016 had some kind of a CRP contract remaining on them. And on average in 2016, we had about 24, 25 sales per county. And that's really important, because if we're going to give back an estimate at the county level, well, then we want to make sure that we've got enough sales of land in that county to base that estimate on. So this gives you an idea of where that average is. What you can see here is that the total number of transactions that we're working with is about 6,800, and then you can see the distribution between the 3 years. And what I'd like to point out is that in 2016, we've actually got an 18% drop in the number of parcels sold. This is not too surprising given some of the anecdotal evidence that I was told about over the last 6 to 9 months, which is that as prices were starting to soften, we had some sellers who were willing to put their ground up for auction and see if they could get a good price. But if they couldn't, well, they didn't have to sell, so they wouldn't necessarily let that land go. So I think that that this drop in sales is not just a coincidence. I think it reflects the fact that we had some sales that would have happened if prices had been higher. So just basically a drawback in the willingness of sellers to let go of ground at a lower price. All right, so here's some predicted sales prices. We'll give you the summary, and then I'll show you some charts of these data. But what I want you to take a look at is this all cropland and pasture. When you average across all the different types, we're just above $3,000 an acre statewide, and that's a 10% decline from 2015. So this number would be comparable to the USDA number that had us down 9.8% since 2014. Well, we dropped just a little bit more than that, and we did it in 1 year. And so the USDA numbers had us starting to fall off in value in 2015 and then again in 2016. But when you add the drop-offs between the surveys and compare that to the drop-offs on this market side, we're right in line. So we are getting similar information whether you look at the surveys or you look at the market data. And so that's kind of the big number right there, is that 10.4% decline across all the different land types. So let's take a look at how this shakes out if we just do these estimates for the different land types. Okay, so here's non-irrigated land estimates from the last 4 years, and the blue bars are the market estimated numbers from K-State, and the green line are the USDA numbers. And so a couple of things to notice in this chart. Whereas the statewide average across all land types declined by 10.4%. If we just look at dry land, it declined 17% from 2015 to 2016. So the biggest drop in land values across my 3 categories, this is the biggest one, 17% decline on the non-irrigated crop side. When you compare it to the USDA numbers, we're generally moving in the same direction. We were still going up between 2013 and 2014. USDA had us down a little bit, and we were relatively flat with the PVD sales, and then we're starting to fall again coming into 2016. So while the numbers that USDA generates tend to be a little bit lower, they're actually consistently about 30% lower, 30 to 35% lower than the market numbers, but they do move together. So again, we're getting similar trends when you compare the survey data to the market data. What about irrigated land? Okay, well, the drop off there is a little less than dry land. It's only about a 12% decline. Why is that? Well, because the crop prices are primarily what is driving this drop off in profitability, and therefore the drop off in land values. And so it doesn't matter whether it's irrigated or non-irrigated, you're still looking at the same prices, but you can get higher productivity off of irrigated land. That helps a little bit, I think, with supporting it, but there's no reason to think that irrigated ground is going to hold its value when you're still selling in the same commodity market as the dry land producers. Here's pasture, and it has had the lowest decline, so it's only fallen off about 8%. And this goes back to looking at that chart of net farm income when you compared crops versus the cow herd, and you could see that for all our cow-calf producers, granted, they're not making as much money as they did in 2014, but they're still getting market signals to expand the cow herd. I believe it was the January estimates that came out and said we're still in expansion mode, which means we're still looking for pasture and we're willing to pay for it. So that has supported the price of pasture in Kansas and kept it from falling off as far as the cropland prices have. Okay, so the county level numbers are posted now. They're out on Ag Manager. I'll give you the link to those at the end of this presentation. But those are kind of hard to try to put them up here on the screen and let everybody look at them. So what I did was I brought them up, averaged them up across the CRD so that you can get a sense of where land values are for 2016 on a statewide basis. So this is where we take that number and with that 3,000 number and we break it out, and you can see the pretty dramatic diversity across the state. And if you're not familiar with Kansas, the western side, it doesn't rain. On the eastern side, it does rain. And so we get a pretty big difference in dryland land values as you move from west to east and you start picking up more inches of annual rainfall. Take a look at the pasture land values, same thing. We have quite a bit of discrepancy when you go from southwest Kansas to northeast Kansas. But again, it's just reflecting the relative productivity of ground as you get more rain and the quality of the soil as well. That's what's being reflected here. Then on the irrigated side, I don't publish irrigated land values for north central or central Kansas. It's not that there isn't irrigated land there, but there are not a sufficient number of sales to be able to reliably estimate those values. So here we have just for the regions and for for the regions and the counties that we have enough sales. Hold on, looks like I have there we go. Okay, so long run growth. Let me go back here. What I just gave you was the year-on-year changes between 2015 and 2016. And they're pretty dramatic, but let's put this in context with where the profitability has been. It shouldn't be unexpected. We've had basically 3 years in a row of poor returns to cropping, and we're looking at 2016 as our second year in a row of likely very low, if not negative, net farm income. So where does this fit then going forward? I don't love to make projections about a lot of things, but I think it is worth taking these numbers and saying, well, where does this send us going forward? Is this it? Are we done with the correction? We came down 10 to 20%, and that's good enough. Probably that's a little too optimistic. This chart is using corn and soybean prices going out. It goes back to 2003, and actually we put it into a long run calculation of income going back to the 70s and put it into an econometric model, trying to figure out what today's income levels suggest about where land values need to be. And so this is work that I did with Dr. Alan Featherstone and a graduate student, Heather Gibson. And what we did was we looked out. You can see those last couple of years, those are projections of income, and they're basically flat. The futures prices aren't indicating any kind of a major correction in commodity prices over the next couple years. Not that that's easy to project. And then we took a localized basis and put that in there. It's worth noting, even if futures prices were to improve, our local basis is so wide that our cash prices in many parts of the state have been between $1 and $1.50 under futures, and that's really, really wide relative to normal. So we're using a slightly longer run basis level, but again, even if futures prices correct, our basis has to narrow up in order for us to realize some of those gains on the futures market. And to be honest with you, until we get rid of some of that grain that's sitting on the ground out in central and western Kansas, it's not going to happen. So we're a little ways away from seeing some improved local cash prices, in my opinion. So if we take these projections for income and put them into a long-term model, basically what we find out is that we've got a long-run implied capitalization rate of 4.6%. Well, what does that mean? Basically what it means is that the projected farm income of 46 bucks an acre in the long run, we're going to go back to a real land price of just at about $1,000 an acre. And that is a decline in 50% from our peak in 2014. So what we're saying is, given today's income and our expected income for the next couple of years, if this land market is going to correct itself to its long run cap rate, then we are looking at land values falling off about 50% from the peak in 2014. And when I looked at that chart, I think it brings us back down to land values that are right about where we were in 2006. Another way to look at this, and this is not an econometric model, this is just charting long run growth rates of Kansas land values going back to the 60s, but you can see that there's three different growth rates here. There's the red line, the green line, and the purple line. The red line is the growth rate that the geometric growth rate that you'd have to get us to where we are today, and it's at a rate of 5.3%. And so that's not your cash returns. This is the increase in your equity in that ground is appreciating at a rate of about 5.3% annually. Well, the long run, the very long run growth rate is more like the purple line, which is about 4.3%. And so the thing is that if we were to correct back to that long run growth rate, the one that we seem to settle back into, we settled back into it after the 80s, which you can see in about 87, 88, we settled back to that green line. We've also corrected down in 2002, 3, and 4 to that purple line. So somewhere between the green and the purple is where we're going to end up. Well, what is it going to take for us to get back there? What kind of a correction? A 30% decline to get back to that green line, or about a 48% decline to get back to that purple line. So the story here is that a 17% decline, or 10 to 20% decline that we've seen so far, we're not done yet. Not unless something dramatic happens on the income side and we're able to either slash cost of production or commodity prices come way up. But given that those things aren't likely to happen quickly, we are headed for needing to correct further than we have already in order to be in line, have land values be in line with where profitability is today. Okay, so I figured that I wouldn't be the only one to put my opinion on the line today. I'd let you guys help me out. And we sent out a survey on Monday asking you what you thought land values were doing going into 2017 in your part of the state. And I really appreciate everybody that answered the survey because we got some really good data. We have about 114 people who responded. The vast majority of the values were for Kansas. I only had 6 observations for the other states, so I'm not able to put up any information about Nebraska or Colorado, but I am going to put up some information for you about the 6 regions of the state. Here's the response rate by self-identified occupation. So lenders were made up about 34% of the answers, producers made up 32%, and people who could be categorized as some other occupation, extension agent, insurance agent, educator, number of different things, make up about a third. So we're pretty even across these 3 categories of respondents. So let's take a look. Basically, our lenders are the most pessimistic. They come in at an average statewide of negative 11%. What I thought was pretty striking was the variability across the state. The region that looks to be doing the best is Southeast Kansas. People either said that it was stable or it was only down around 5% in Southeast Kansas. The other part of the state that seemed to be doing reasonably well was South Central Kansas, ranging between 3, 7, and 9% for a decline. The same thing, again, I would say with Northeast Kansas. So the eastern third of the state seems to be not experiencing some of as much of a decline in land values, but if you take a look at the Northwest Kansas responses, they're pretty extreme. I was a little bit surprised that for Northwest Kansas, producers were pretty optimistic at only a drop of about 6%, but our other 2 categories were ranging between 16 and 20% declines in land values for this coming into this year. And then Southwest Kansas also has between 9 and 14% declines. So this was interesting. We got quite a bit of variability, and I really appreciate your observations because I think this adds just one more piece to the puzzle, trying to help us figure out what's going on. I think it's worth noting that this kind of a fall off in land value, no matter what part of the state you're in, it probably makes lenders nervous. So they've got that, they're a little more pessimistic than everybody else in terms of what they see and what they've been hearing about. And I think one of the things that I've stopped talking about whether or not we are going to go through something like the 80s again. We're going to go through something. It may or may not look like the 80s, but it's going to be its own thing. We're going to call it its own event. So I don't know what we'll refer to it as, but it'll be its own thing, distinct from the 80s, but worth noting. One of the biggest problems that hit producers in the 80s was as land values started to fall, it made lenders nervous, and some of those lenders ended up shutting down access to credit. liquidity is key right now for producers. Having access to credit and being able to keep themselves in a liquid position to get through the next couple of years, that's how we'll pull back out of this and start to see land values start to come back up again. So I think that's probably the thing that makes me the most nervous is I don't want to see wholesale cutting off of credit to producers just because the land values have started to correct. Let's do a quick summary. Land values, we've got non-irrigated cropland down about 17% from 2015. Irrigated cropland down 12 and pasture down 8. We could be heading for anywhere from a 30 to 50% decline. So we're on our way, and nothing catastrophic has happened yet, even though we've moved pretty significantly. So another year of corrections would get us pretty darn close to the boundaries of that 30 to 50% decline. And I think we can do that without the roof caving in on us. Some other comments. I had a good visit with a gentleman in Great Bend the other day, and we got to talking about auctions. And this is roughly his quote, was that he had attended 3 auctions in the last several weeks. And at one of them, there were only 12 people, which is a pretty low attendance for a farmland auction. At another, there were over 100 people, but only 3 bidders. What this is starting to look like is a lot of reluctance on the part of farmers to invest in this farmland. And farmers are, and I don't see why they won't probably always be, our biggest buyers of farmland. And so when they're reluctant to buy, probably because they're trying to guard some of that liquidity, not putting it down on land so they can make sure they have access to it for the next couple of crop seasons. That fall in demand, I don't expect that outside investors are going to come in and all of a sudden prop up the land market because they see a good deal. It is a good deal on buying the ground, but the cash flow scenario right now on buying ground is pretty poor. So I think the turnaround is going to happen when we start to see projections for net farm income come back up, and then we start to see farmers being willing to buy farmland again, and that's when we'll start to see a rebound in these prices. Okay, so here is the location of some online resources pertaining to farmland. We've got the Ag Land Values Bulletin, which is the county level estimates of what I just showed you today. So that's available at Ag Manager. You can also go look at some rental rate estimates for 2017 if you haven't already looked at those. If nothing else, it gives you a pretty serious look at the expected profitability, because that's what those rental rate estimates are based off of, is projected profitability, and it's pretty poor in certain parts of the state. And then I'll real quick plug our pasture rental rate tool, which is a spreadsheet that allows you to take information about stocking rates and calf prices and put that into a rental rate tool that helps you to estimate what you can afford to pay for grass. So those are some different things that you can take a look at. I'm going to stop now. I've been talking for quite some time, longer than I wanted to, but I'm going to see if I can pull up the Q&A section. And if anybody wants to start asking some questions, that would be great. Okay, start with the first one here. Does the state of Kansas allow formal land appraisals to be done by non-licensed certified appraisers? I assume it doesn't, but I don't know the answer to that question. That would be something to ask somebody at the state of Kansas. I assume you have to be a certified appraiser to do a formal appraisal. Are the variables of public auction versus private treaty accounted for? Not in this particular model. I don't have good information on that I've been able to use, but I have seen previous research that shows that land that sells at auction will sell for about 10% more than land that sells private treaty. That's all well and good, but then you've got to remember you have to pay a commission to the auctioneer. So the bulk of the premium that you might get selling it via auction is probably going to get eaten up by the commission to the auctioneer. Mr. MP, what time frame do you see for land values reaching the bottom of the correction? I think it's going to take about 2 more years to reach the bottom of the correction, and I say that only because there's nothing in the next 2 years that says that our income is going to come back up. And that's what I think has to happen, is our net farm income projections have to come back up in order for this correction to finally kind of hit it, bottom out. So I'd say we're probably still in it for 2017. 2017 could be possibly one of our worst years yet for profitability, just because we had such good yields last year. It gave us more crop to sell even at poor prices. Well, if we have not a lot of crop to sell at low prices, that's going to be a tough year on us. So yeah, I'd say we're a couple years out from the correction. Do I have any data about whether Kansas banks are significantly tightening credit? No, I do not. And so I don't want to give the impression that I know that they are, or I've heard that they are. I think it's just one of those lessons that we learned from the 80s, was that it doesn't help the situation if that were to happen. And so I think we have to trust that we've got some folks in charge of our Kansas banks who were lenders during the 80s, and that they know that they understand the implications of what happened during that period, and they're going to apply that experience to what we're seeing right here, because I think there's a lot of similarities. Okay. How many years? Oh, looking at the 4.8 and the 4.3% trend lines, how many years would it take to get up to today's values? So it's kind of, that would be kind of like Tanner's question about how long it would take for us to correct. And if you just followed those lines, it just depends on how quickly we would fall off. We could get to those lines in 1 year if we had a really bad year, or it could take us 3 to 4 years to get to those lines. So I don't have a projection on how quickly we get to those lines. I just think that's where we're headed. But if you look at the fall off from the 80s, which we would all agree was a pretty tough time, we didn't fall off, precipitously. It was just a slow, steady, okay, we just keep losing 10% a year for 4 or 5 years in a row, and then all of a sudden we find ourselves 50% below our peak. I think that's the more likely scenario, that the fall off will look, pattern-wise, will look a lot more like the 80s. Okay, pasture in our area is near 60 bucks an acre. That's a long ways from 1750. Oh, 6,000 an acre maybe? I'm not sure about that one. Yeah, okay, so it's worth noting, everything I'm putting up here is averages for average quality ground in your county. And you will see grounds that will go for a heck of a lot more, and you will hear about ground that goes for less. It's pretty hard for me to be able to put into an economic model something that basically accounts for the fact that if you have an auction and you have the right people there and you have the right people interested, you can really run up numbers. So no, there's no way for me to account for all the variation that we can see. And even in your responses, when we went back to that and looked at those responses, there's quite a bit of variability when you ask a lender versus you ask a producer versus you ask somebody else in the industry. You'll get quite a bit of variability in what they've seen and what their experience is. So we can talk averages, but it's the variability that's also pretty key here. Oh yeah, there was a mistake on one of my slides. It came out, those numbers came out in August of 2016, not 2015. I apologize for that mistake. Okay, Matt Metzger, what's the likelihood of following below the geometric growth trend, just as we've been riding above it? Well, it's possible, but all we have to look at for how did it go last time is really the 80s. And so we're kind of dependent on going back to that long-term rate of growth. I would find it very hard to believe that we would fall below the long run, that 4.3%, that we would fall below that for very long, because that would mean that land was a heck of a deal relative to 50 some years worth of production in the state. And so I think that it would get bid up pretty quickly. I just can't see us falling below that long run growth rate, because that reflects structural conditions in the land market in Kansas and our ability to take advantage of technology and the improvements in our crop from a drought resistance and so on and so forth. So I just don't see us falling below that. I don't think that's very likely. Other questions, other comments? For as many people as are on this, you guys are kind of quiet. Okay. Okay, Lynn Hennigan, she's hoping that it's 10, 20, or 30 years out. I think it's more like between 3 and 5. That's my best guess. I think it would be worth the effort to send out an anonymous post-seminar survey of cash rents to see what people are paying versus what the data shows. Would you be willing to do this? Sure, if you guys are willing to answer the survey, I'm always willing to send it out. We're going to send out a survey to you when we're done here, just asking for your feedback on the webinar. We can add a question or two there saying, what do you know about cash rents? That's a whole other ball of wax. It's related, but I decided not to address cash rents directly in this webinar because I think we could spend another one entirely talking about them. And right now there's a lot of uncertainty. Most folks know or are pretty confident that cash rents should come down from the peaks that we saw a couple years ago, but there's so much variability in when we renegotiate those rents that you can't say wholesale that everybody's rent should come down. Some people's rents never went up. So there's quite a bit of variability there, and it's hard to know, what they should be doing. But yeah, we can put that question in, see what we get, and then probably what I'll do is post it on a slide, just like I did with your answers to the land values, and put that out there. I enjoyed doing that survey. I hope you guys didn't mind filling it out because it was pretty interesting just to see your. What rate of return will it take for investors to get back in the market? That's a good question. The rate of return it'll take is something higher than a comparable investment in terms of risk. The Fed is starting to increase interest rates. That's going to make some relatively safe investments start looking a little bit better. I don't consider the stock market to be a perfect substitute for farmland. Even though we are going through, quite a bit of volatility right now, the stock market, you can lose all your value in one day as opposed to over the course of a few years. So it really has to be comparable risk, probably a little riskier than T-bills or CDs. But I think that those rates of return as they're coming up, I think then the farmland rates of return are going to have to push up. And if I were to throw a number out there, I'd say we need to get back to the numbers we saw in 06 and 07, where your dry land return was somewhere between 4 and 5% of a cash rent to value ratio, and your pasture would be somewhere between 1 and 2%. Rental rate on pasture. Okay, I don't understand that question. Thanks, Luke. Can we view the webinar again online? Yes, this is being recorded along with all of the Q&A. We're recording it and we'll post it so you can watch it again if you want to. You can also you can send links out to anybody that you wanted to see it. We've got previous years, but nothing as exciting as what we're doing right now. So any land value projections based on state of Kansas water conservation suggestions, requirements, speculation. John, thank you for your question. There are a couple of projects that I'm working on with some colleagues here where we are trying to work in the land value data with what we know about the hydrology of the water situation out in western Kansas. These things don't ever move as quickly as I want them to, but hopefully we'll be able to get out some estimates within the next 6 to 9 months. We don't move fast, sorry. How will these possible decreases affect taxes? We can't get out of here without talking about taxes, can we? Okay, so for better or for worse, your property tax rate is not based on the market value of the land. So it didn't go up when the market value went up, and it's not going to come down just because the market value is coming down. It is called use value. It means that it's based on the profitability of it as a function of yields and commodity prices. So basically use value is reflecting, it's like looking at the share that a landowner would get. It's basing it on that profitability. The thing is that to smooth that number out so it doesn't make big jumps year in and year out, it's an 8-year average of an 8-year average. Well, what that particular calculation does is it weights the average, so it's not a simple average or every year gets the same weight. The middle years get the highest weight, and I think the years in the equation now are 1999 to 2015. And so our best years of profitability are moving towards the center of that average, and the closer they get to the center of that average, the higher weight they will get, which means that your property taxes will go up. They've been going up, they've gone up the last 2 years, they're gonna go up for a couple more years. And that has to do with the profitability that you were making off of it several years ago, not the profitability you're getting off of it today. Now, 5-6 years down the road, today's poor profitability will make its way into that formula and your property taxes will fall again. But there's easily a 4 or 5 year lag on how quickly you see the current conditions factoring their way into the tax calculation. So I hope that made sense. On the lender side, it's been difficult to get good appraisals because of a lack of recent comparable sales. I can appreciate that. I can appreciate that very much. Appraisers are really struggling to get the latest information, and they're worried about that. And I agree. If there aren't any sales happening, then that's another problem as well. So appraisers are in a tough spot right now. They're trying to get some information, the best information they can, but to be honest with you, I think that information is changing daily. It was the same way when prices were going up. You could appraise a piece of ground and it would go for even more than you appraised it for when it did go up for auction. Now we might be on the flip side of that. So that's an issue. Lender from Northeast Kansas here. Feel that bankers aren't being more negative, they just have better data. That's very possible. Most farmers and ranchers hear about public auctions and high sales, and they don't always hear about the private sales or other transactions. That's a very good point. Lenders do have better information. And, you know, to be honest with you, the lender's number was more in line with the numbers that I put out. I think we had you guys at 11% down for farmland, and the average statewide from this model based on the PVD data was 10. So I think that, yeah, you're right, you do base it on more information, but I think it's worth noting that you do get a different answer depending on who you ask. And so, you know, we're all seeing something different right now, and that expectation that we form based on what we're seeing, that has a lot of impact on our behavior. Okay, did I account for mineral production? No, I don't have mineral rights. I don't have hunting rights or recreational use. I don't have mineral rights in the data, so I can't account for that. We just know that, yeah, there's differences if it's, but on the mineral side, I will say that if the mineral rights are developed, then they tend to not be sold with the ground. You tend to see that land sell without the mineral rights, whereas if the rights haven't been developed yet, that's more likely than to be transferred with it. Okay. Oh, so I'm going to answer a question over here that is coming in through the chat box rather than the Q&A. It says, how much of a discount do CRP acres sell for compared to dryland acres? It depends on what year we're talking about. If we were talking about a couple of years ago, that discount could be as much as 10 to 14%. In a year right now, where some people might look at that CRP rent as being, you know, a nice safe alternative to trying to farm it, that discount's going to be 4 or 5%. So it kind of depends. It very much depends on what economists like to call the opportunity cost of that land. No wind turbines. Sorry guys, I don't have that either. Okay, so we've got somebody who's trying to figure out when's the best time to sell ground. That's a personal question that kind of depends on your situation. I don't know where we'll be 8 or 10 years from now for the market to correct. I don't know how long it will take us to get back to where we're at today if we do have that 30 to 50% decline, because then, yeah, we'll get back on that growth rate. We'll start chugging up again at about 4% per year. So you could be 20 years out before you got back. I don't know. That's way, way, way too far to predict out. So I'm not going to be able to answer your question. I'm sorry. Any insights into the slower decline in irrigated versus non-irrigated? Again, I'm just going to chalk it up to the higher productivity of irrigated land. I think it will always back off a little bit. Everything else equal, I think that it will not lose its value as fast as dry land. And honestly, if we had the same profitability in the cow-calf sector that we have in the crop sector, it's pasture that would have dropped off the biggest. I think what we tend to see, and I've heard about this anecdotally, but I'm also looking at it in some econometric models, is low quality land falling off first and the highest quality land holding its value. And I have heard that from a lot of people that, you know, when you ask what land values have been doing in their area, they'll say, well, tell me what quality of land you're talking about. If it's poor, then that has fallen off. If it's really good ground, that hasn't. So I hope that answers your question. Does it include land that has a conservation easement? The best I can tell from the information is that it marks if it has some kind of a government program set aside, but I don't have, the PVD data might include conservation easement information on it for appraisers, but the version of the data that I have does not include that information. And do I know how many people are participating in the call today? Rich would have to answer that question. I don't know where we're at.
We had, at the high point, we had 322 that were viewing it, and we had 31 more that were on the phone.
Sweet.
So about 353.
All right. I'm pretty sure that's a record.
That is a record.
That means Art's buying my lunch. All right. What impact do farm bill programs, Title I and crop insurance play in market values? There's been different research trying to answer that question. The thing is that it depends on how long of a period of time you look at. Does it support land values? Yeah, but you have to recognize that everybody basically qualifies for that across cropland, right? We all qualify for the Title I. We all can have access to crop insurance. So I don't expect there to be a big differential across land for that in terms of how much it makes up. I don't know that number off the top of my head. If I had to guess, it'd be in single digits, but that's just an educated guess on my part. Do I have information about the process PVD chooses which sales? So I'm going to repeat it again. They don't use sales. PVD does not use sales to calculate taxes, okay? And then if that's not your question, if you're asking about the data they give me everything. They don't cherry pick. They don't decide which sales they're gonna let me look at and which ones not. They give me everything. It's my decision to do things like drop the parcels that are 40 acres or less. And so that's something that I do, but PVD gives me all the data. But just a reminder, sales data is not used to calculate your property taxes. I'm guessing that conservation easements do something similar to CRP. It might be a couple points more of a deduction just because they are in perpetuity. So you can never use that land for anything other than what the conservation easement allows. So, you know, that's probably a good guess, is that they would have that. If I was given the opportunity to buy a poorer piece of cropland through private sale before they take it to auction, would you buy it privately or wait for the auction, thinking they think it's more valuable than it is? Auction might give them a reality check. That's a good question. I think what you are willing to pull the trigger on needs to be a function of what you think you can get off that ground productivity wise and what you think it's worth. If it's valued well for you, then that's a good piece of ground to buy. If it's too overvalued for what you think you can get off of it, then I'd let it go to auction and see what happens. Okay, so the projected long run price of land is $9.90. Oh, okay. A decline of about 50%. The $9.99 is a real land price. The purple and green lines we were showing on those values were not, oh shoot. I think those were real as well. So are we expecting another 10% decline over the next 2 years? Yeah, roughly 10 to 20% decline over the next couple of years. seeing more no sales in our region than we have for a long time. Hard to tell. Yeah, that's a good point that Perry Briggs brings up, which is that when there's a no sale, you know, I can't observe what the last bid price was on it. PVD only gets the sales, something that actually trades hands. And so having a fewer number of sales in the PVD database this year, really, it's leaving out some depressed prices that, you know, were the final bids, but since land didn't actually sell for it, we can't see it. So that's a tricky one. Okay, how much does tract size affect price? 80 acres versus 160 versus 320. I don't remember that impact off the top of my head, but I do have, I think send me an email and I will get you that information. I have that calculation somewhere. Okay. Yeah, the 999 was a state average. That is correct. How to estimate by county. You have to use your best guess. I think it's a combination of recognizing that some parts of the state are not going, when you look at a state average, and let's say we pick that 30% mark. If we say that the state average is going to drop by 30%, I don't expect that everywhere in the entire state is going to drop by 30%. I expect that, for example, Northeast Kansas, maybe Southeast Kansas will only drop by, say, 15 to 20, and then I expect that Western Kansas is going to drop by 40, and that's how you're going to get that 30. You're not going to have 30 statewide, and that is where you have that impact of high quality ground versus low quality ground. And if you look at it at the state level, that's the difference between Eastern Kansas versus Western Kansas. So that's how there's no scientific way for me to break that out by county, because we don't have enough information at the county level. But I can tell you that, yeah, it'll be less of a drop on the eastern side of the state and a bigger drop on the western side of the state. All right, well, I am guessing that we've got some folks ready to go eat some lunch. And so thank you very much for your questions. Thank you very much for spending your lunch hour with me. I appreciate it. I will send out a survey for you. I hope that you respond to it, just giving us some feedback on the webinar and what you'd like to see in the future. And then we'll also ask that cash rent question, see if we can get enough observations, and I'll make a table and put it into the slides. And these slides are also posted on Ag Manager, so we'll update that file if we get enough information on cash rents. Rich, unless there's anything that you would like to add, I'm going to go ahead and sign off.
That's it. Thanks. Appreciate you all being on, folks.